So the bank is using your money to lend to other people who need to borrow money at a higher rate. So that's how that money is being cycled through the system.
That's what I meant by the bank not asking enough questions. They're just order takers. They're not asking the questions.
A lot of time the client's perspective is safety, right? Safety is not the same as security, people. Okay, you have to understand that there's a difference there. A GIC feels safe because it doesn't move, right? You still have your money per se. But in 5 years, inflation may have quietly eaten away 10% of your buying power, if not more.
I think it was Warren Buffett who said the best time to be in the market is when you have money, and the next best time is now.
We want to invest in things that are going to grow, not depreciate. I want to make this purchase, but they have that like, should I, shouldn't I kind of struggle, right? The reason why you're doing that is because you haven't set up your financial plan properly yet. Do you want to retire where you're struggling, or if you're going to enjoy your retirement? You have to figure that out. The banks love GICs, high interest in your bank account. They love those three entities, and that's what's highly promoted. I don't think you can borrow money at any less than 10%. They're only giving you a 2% or a 1% rate of return. Do you want to be driving a beater in retirement, or do you want to be driving the Ferrari in retirement? You have to make that decision.
That would be awesome, guys. If you're like 25 and you're listening to that, it's 100% possible.
100% possible.
Welcome to our podcast, Keeping It Real, where we talk about real financial problems with real people and we come up with real financial solutions. My name is Irene Meyer.
And my name is Philip Villanueva. How is everyone today? So Irene, I want to talk today about a very important topic for the general public to somewhat understand. Okay, so would you agree with me that most Canadians think they're investing when they sit down with their bank, but in reality, banks and brokers use the same tools, GICs, TFSAs, RRSPs, savings account, but in very different ways? Like one builds wealth and the other possibly maintains profit for the bank. Would you agree with that?
Yeah, it's a very leading question. I don't know if that was meant to be or... Yes, I do. Yes, I've seen it.
You've seen it, hands down. Okay. Well, today we're going to unpack how these products are used versus how they should be used if you want money to actually work for you. So I want to start with the idea of GICs. And GICs, they're guaranteed investment certificates, right? They're used heavily in the banks, right? And they're marketed as kind of safe investments versus, to risk adverse clients, right? So to clients that are scared per se, we'll use that term scared, right? Now, you've worked in the bank yourself, right? How would you say GICs are often used in the banking system?
Okay, so usually guaranteed investment certificates are used by bankers, either A, because that's the only thing they can present, meaning they're not licensed to sell the bank's mutual fund, or B, the client deliberately asks for safe. Okay, so I can recall on many occasions when someone would have a bunch of money to invest for a client, and the client would say, I don't want any risk. And they immediately go to selling a GIC. Now, that's okay. At least you kind of did what the client asked. But you're not really, just by selling that product, you're not really actually determining why they're opposed to something else. And using the word safe is kind of objective. So the one thing that bankers can't do very well is ask more questions. Okay. And then you have the one banker who might actually want to do more than just GIC type investments. They're starting to get their mutual funds licensed, because you have to be licensed in banks to be able to do more than just GICs. And they still haven't gotten their license, but they want to help this client because it might help, make some quotas that they're responsible for. They're just going to throw them into a GIC. Now, the good banker will probably move this client to the office next door where the person has their mutual funds license so that they can be properly served, but they don't do that. Okay. They'll take this person, and maybe if they were smart enough, they might put them into a redeemable GIC and then contact this client once they do get their mutual fund license and properly invest them. But most bankers don't do that. It's like one appointment after another. They need to get them through their office as fast as they can every day.
Yeah. And then oftentimes they start, like you had said, the person says, I want to have a safe investment where I'm not going to lose money, right? However, the banker doesn't clarify for them that oftentimes the rate of return on a GIC is under the inflation rate, which means they're technically losing money.
Right.
right? So that's often not explained. And then on top of it, now that money often, so let's say I invest into a GIC because that's what I've been convinced to do. Oftentimes that money is left in the banking ecosystem, right? And
Yeah.
that's how the bank uses those funds is they're taking your money that's making under inflation rate returns and they're lending it to the next person who comes in at a higher interest rate to borrow money. So the bank is using your money to lend to other people who need to borrow money at a higher rate, right? So that's how that bank is, or that money is being cycled through the system. All right. Now that's how the banks would use them. Now, as a broker, okay, and I can speak on this, and maybe you can clarify this. GICs can often be used in a short term, what we consider parking situation, right? Not with the intent of long term growth. It's ideal. It's ideal for like a temporary fund, mainly for like emergency buffers, or even to help balance out the risk in some retirement portfolios, right? It's a strategic attempt, not just something that we do because we're trying to play it safe for the client in an indirect sense, right? So we focus more on diversifying the retirement plan, not just locking up the money for minimal gain, because we're thinking about the long-term gain. Like we're thinking about the big picture, not just what's going to happen in the next 1 to 5 years, right? Would you agree with me on that?
I 100% agree with that. That's what I meant by the bank not asking enough questions. They're just order takers. They're just order takers. They're not asking the questions. You know what? And it's interesting because I mean, like I said, I used to, or like you said, I used to work at the bank for many years, and I realized, my errors back then as to what we did. I'm not naive enough to know or to think that I was never doing that, or as a young banker I never did that. But a lot of the time we took it upon the client to know what they wanted, and that's why we were order takers, which is blows my mind now, because so many people, most people, do not even know what they're asking. They don't. They found out from their friend that they need a TFSA. They don't even know how it works. They say, well, it saves on taxes. And when you actually figure out the calculation as to how much taxes they save on this high interest savings account they have in the TFSA, you're like talking pennies, if that they're saving on taxes, right? Or people talk about RSPs, and this was a very big thing at the bank, like our registered retirement savings plans, where they need because they need to retire one day, not knowing that the new TFSA that came out in 2009 is a great opportunity to save for retirement as well. And this is like where if you don't do your homework, you don't talk to someone about your lack of knowledge. And this is where I think where people have a problem is they're not willing to admit when they don't know something. So therefore, it's just easier to say, I want this, not knowing what they're asking for. And then the person on the other side of the counter saying, okay. And then both are doing wrong. Like both are doing wrong because no one's willing to admit that they don't really know what they're doing or asking for it. And like, folks, there's nothing wrong with not knowing because we weren't taught this in school. We weren't taught this in school. And bankers, you weren't taught by your manager about how to properly help clients either.
Well, and that's on the assumption the manager even knows. Like you said, you were a manager and your mind is blown now, knowing what you know now as opposed to what you knew back then. So that's on the assumption that the manager who's training this staff member actually knows anything about this stuff as well. So in the end, when it comes to GICs, the idea of GICs from the banking perspective is, and the client, a lot of time, the client's perspective is safety, right? Safety is not the same as security, people. Okay, you have to understand that there's a difference there. A GIC feels safe because it doesn't move, right? You still have your money per se, but in 5 years, inflation may have quietly eaten away 10% of your buying power, if not more, right? So be very understanding of that. That I like to say, sitting money is a depreciating asset. Okay, think of it like that. Oftentimes, we accept that with vehicles. When we buy cars, we know we're going to lose value on our cars, right? Do we want to do the same thing in our money and everything else in our life? No, we want to buy appreciating. We want to invest in things that are going to grow, not depreciate. Okay. Now you touched on a few other things in that conversation, and I want to move forward with that. And I'm glad you mentioned. And let's start with the tax-free savings account. I want people to understand the tax-free savings account can have a lot of different umbrellas, a lot of different hats. GICs being one of them. They can say it's a TFSA in a GIC, right? So we're talking about tax-free savings account as standalone investment portfolio. Okay, that's what I want to discuss now. Okay, so let's discuss how the banks oftentimes, and I've seen this so many times with clients, how the banks use it. Okay, so I'll let you start, Irene, and we've probably come across the exact same scenarios how banks use these TFSAs.
Yeah, they use these tax-free savings accounts. And again, I don't know if it's a lack of training or a lack of knowledge or even the lack of initiative to want to know more. But in my experience, where tax-free savings accounts first came out, it wasn't used for long-term planning. It wasn't even explained properly. I think we felt like the name it was already explained. And the problem with the name, and I'll be honest with you, it should have been tax-free investment account to avoid that word savings, because you said it right, like safety, versus security. Like when people think of saving, they think of putting money in, and when you go back to it, it's there still, right? Just not gone anywhere. No one put in extra pennies in there to make it grow. It's just sitting there. That's saving, right? Well, if you put in $100 every month, and maybe do the math, you put in $100 every month into a tax-free savings account that's not invested, okay? Because you can have tax-free savings accounts that are invested properly and not at the bank, right? But if you did that at the bank, all you're doing is you're putting $100 every month into it. And when you're 65, it's exactly what you put into it. And you're wondering, it didn't move. I'm like, well, yeah, because you didn't invest it. Now, there are two schools of thought there. There's like, well, the banker should have known that 100%, right? Well, that's usually what happens. Usually they blame, right? But people blame, right, others because no one was educated, right? But it's very possible that banker also couldn't put it into something that was growth oriented. And it comes back to the training in the bank, the licenses in the bank to be able to do this. So the banks used it as and again, this is what the banks are there for, is they're there to accumulate everyone's money in like investments like high interest savings accounts, bank accounts, savings account, GICs, and use that to pay their bills and lend out and make money, of course, right? Because they're doing this with interest, right? So that is their job. Now, I don't really know if that's what the banker's actual intention is versus actually just trying to make a target that they've been given to make. But that's what the overall banks, any financial institution like that, that's their goal, is to make profit. And that makes sense, hopefully, to most of you people. But there are ways to make money, of course, as well as for the client to win as well, if there was just education. So learning about what we're teaching today, about the differences between, like you had said, TFSAs and RRSPs, and then maybe if we can go into the different types of investments for each, because I think that's where people get confused. Can I tell you a story?
Go ahead.
Okay, this is gonna make me look stupid, but I want you to be very understanding of where I was at. So I'm like, just started with the bank. It's December of 1998. I was 23 at the time. Didn't know anything about finances. Okay, I'll be honest. But I got hired to the bank. I got hired to the bank to be a salesperson. That's why I got hired to the bank. And I'm learning about all the systems and products. Again, I didn't know anything about, which I think a lot of people do in general. I asked my boss at the time where I was training, the bank manager of that branch, and he was like, can I ask you a question? Because he was like, hey, is there anything you need? And I remember, and I'll always remember this conversation because I teach my clients this way as well, because it made sense to me. I said, what is the difference? This is before TFSAs as well, okay? But it kind of applies to that as well. What is the difference between an RSP and a GIC? Now, for those of you guys who kind of understand, like, that's a weird question, but most of you guys are like, yeah, what is the difference? Because you don't know. And the way he described it was just phenomenal. But he basically said this. He said there's, again, before TFSAs, he said there's like, think of two different umbrellas of money. One's registered and one's non-registered. You can have any number of types of investments, GICs, mutual funds, high interest savings, checkings under both. So when we're talking about RSPs and you're asking the difference between a GIC and RSP, that's a very weird question because the GIC can fall under an RSP. And when I explain that to people, I actually kind of bring it to car analogy, and you'll appreciate this. It's like asking the difference between what's the difference between a double garage and a Dodge Caravan? That's the equivalent. That's like weird, right? You would say, well, the Dodge Caravan goes into the double garage or single garage or whatever I said. Like it goes in there. They're not even the same. You know what I mean? You could put a Dodge Caravan into a single garage and a double garage. They can fall under each garage. It just depends which kind of garage you want. Think of that as registered and non-registered. And the Dodge Caravan is your GIC. That was my experience being a new banker and being courageous enough to ask that stupid question, but having a mentor at the time to be very patient with me to explain it to me. And I use it to this day to explain to people my age who still don't know the difference.
And they still might even be confused even now, more so.
Maybe.
Yeah, because they're going to say, okay, what does all that mean when we're talking about, I just want to set up an investment. I just want to start investing my money. That's the way the client thinks, right?
Totally.
And this is where, unfortunately, people get very, very confused because there are people in the financial industry that are dealing with this kind of stuff on a daily basis. The lingo, the terminology, the ideas, the principles. I've got the average person here who just wants to save money. That's all they want to do. So people, tax-free savings account. The general public, oh, savings account. TFSA equals bank account, right? No, okay. But the banks don't explain that to you. They don't explain it. Or very rarely. I'm going to credit some bankers out there. Very rarely though, because that's exactly how it should be used as a tax shelter or or some type of investment portfolio. Okay, and that's how brokers use it. We use it as a growth engine, right? And that's kind of what we're talking about. We're housing equities, managing funds. We're prioritizing the long-term compounding rate of return on these investments. We're looking at long-term growth, okay? And the whole idea is building your net worth, building your literally wealth building, right? That's how we look at these. We're not looking at this as a bank account that we're using to pay our bills and use every single day, okay? We're looking at this as a wealth building program, something where, I've got this set aside for me and it's growing every day, every minute, every second, right? I'm not thinking about it anymore. It's just happening. I've got this account that I'm spending my money on and paying my bills and living my life on. Okay. So what I have in this account, that is all I have. I do not have this one. Okay. And if you live off of this other one, you'll be fine because you'll have that peace of mind. Oftentimes people will say, hey, I want to buy this. I want to make this purchase, but they have that like, should I, shouldn't I, should I, shouldn't I kind of struggle, right? The reason why you're doing that is because you haven't set up your financial plan properly yet. It's not finished. You're still polishing it off, right? But if you can polish that off, you no longer have to worry about that. I have this account. I have the money in this account. Okay, yeah, I can buy it because everything else is happening in the background, right? That's kind of the idea of that. So we're strategically using tax-free savings account along with our other savings tools and our other budgeting tools and our other retirement planning tools to grow our net worth for when it's going to be important, right? That's the thing, is it's not just by itself though. It's with other entities, okay? I don't want you to think of a TFSA as just like a bucket of money, okay? It's literally a tax-free vehicle, okay? That's what it is. It's a tax-free vehicle. What you put inside that vehicle determines whether or not you are driving, a beater or you're driving away in a Ferrari, right? So you have to decide, what do you want to retire as? Do you want to retire where you're struggling, or if you're going to enjoy your retirement? You have to figure that out. You have to make that decision. And here's the thing, you can't make that decision at 6. You have to make that decision now. The minute you hear this video, you need to make that decision, and you have to make the right choices, because the choice you make directly affects you in your not too distant future. Okay. So now we've talked about tax-free savings account, the most common known one when it comes to when people talk about retirement, because it's right in the title, right? It's the retirement savings plan. And again, it's always in the titles, and they really should. Like you had said, Irene, tax-free savings plan, right? Retirement savings plan. Savings is always in there, and they should really take that word out, because these are not savings accounts, right?
Yeah.
Now, RSPs, registered retirement savings plan. The banks, we hear this oftentimes. It's RRSP season, right? And even brokers will play along with that, because that's what the general public knows. That's what they hear all the time. It's advertised. Like the institutions spend a lot of money advertising RSP RRSP season.
Yeah, I honestly think that this is me on my soapbox now. I think that if they spent half of the money they do on marketing on just training their staff, they would probably be more profitable and they would be getting a lot more loyalty from their clients. I mean, I would say that even just in the years I was at the bank, near towards the end of my career at the bank, the RSP season kind of dwindled away. It did. And when I think about it, more and more people are putting money into their registered retirement savings plans on a regular basis, so either through payroll deduction or just like through taking it out of their account every payday, every month, which is great because you're taking advantage of dollar cost averaging. Now that could be a different video altogether, but timing the market is kind of what used to be something that was discouraged, and time in the market was more important. So I was taught, I shouldn't say I was taught. I think it was Warren Buffett who said the best time to be in the market is when you have money, and the next best time is now, right? So if you had money and like you had attested, don't wait till you're 60. If you have the ability to carve out some money to put towards your future, because remember, guys, I know that it's really hard to kind of get your head wrapped around the fact that this money isn't going anywhere. In fact, you're hoping that it's actually growing. Like this $5 I put into this investment account is going to be, $20 in maybe 4 years. Now, don't take that rate of return to heart, but it's possible. But if you don't even have the $5, did I say $5? If you don't even have the $5, then, and you can't even find that, then how are you going to do that when you're not getting a paycheck? Like, that's the thing. Yeah. Like, you're giving $5 to the person who's not going to be working in a few years. That's what you're doing. You're not blowing it like you are now, because, there are people that don't even know where their money's going, and that's a different story altogether. The key is to talk to someone, just like Phil and I, who know how to help carve out this, $5, $10, $100 a month for you, so that you can give to the person who's not going to be working in a few years some money, because that person's going to be broke and that person's going to still be working.
The registered retirement savings plan, as the title suggests, it's a retirement plan. Okay, we're going to take out the word savings. We're just going to stick to retirement plan. And unfortunately, the banks promote it more as it's a tax refund narrative. That's how they promote it more. It's, tax refunds. So when they're setting this up, there's very minimal tax planning or future withdrawal discussions. There's very minimal discussions about planning, right? And what you also don't know is the RSPs set up with the banks tend to have higher management, right? They tend to have higher management fees. So you're losing with that strategy of, I'm going to borrow money at the end of season to put into my RSP, because now you have to pay that money back too, right? So, if you've got the money to pay it back, that means you had the money in the first place, right? So why wouldn't you, as you had mentioned, start putting that money in right away and take advantage of long-term growth? And like you said, best time to start anything is as soon as you heard about it. That's the best time. As soon as you hear about it, that's the best time to start anything, right? And again, so the difference between the way the institutions use it and a broker is we're literally integrating RSPs into an actual plan. It's not a standalone entity, just like a TFSA. It's not a standalone entity. It's part of a strategy and a plan, and it's incorporated when it's needed, if it's even needed. It might not even be needed in the plan, right? So we weigh out, things like, as an example, RSP versus TFSA, and we look at, income level, age, future tax brackets. We're looking at like all of these things, and we're weighing it out, right? How do we use it? When do we use it? Things of that nature, right? We look at as RSPs like tax deferral methods, not just refunds, right? There's a big, and if you don't know, do a Google search on the difference between a deferral and a refund, right? Really, the internet's out there, so it's easy to figure these things out. We're looking at the big picture. What happens when you retire as to what's happening now, right? What is our income level when we retire as to what's happening now? What is the purpose? What is your purpose of why you're sitting with me here today? Right? What brought you here? Right? And then we have to plan around, like, at some point, great, you have an RSP. Great, you've been saving it up. You have to start taking the money out. At some point, what happens then? Right? So anyone out there who has gone to the institution and set up an RSP, how many have had the conversation, and write it in the comments, where that advisor at the bank asked you, what are your plans for when it's time to take this money out? That's not going to be asked. right? So banks sell RSPs like it's free money every February.
Yeah.
That's how they sell it. But what they don't tell you is you're borrowing that refund literally from your future self.
Yeah.
Right.
Yeah.
So you need to understand that. That's really, really important. Okay. So going away from these avenues to actual savings. We've talked about savings accounts, savings accounts. Okay, let's talk about an actual savings account. The acronym being HISA, right?
High interest savings account.
High interest savings account. Okay. So there's some use to high interest savings account.
Sure.
Sometimes I lean towards, a lot of times actually, I lean towards them more than I do GICs, right? So
Yeah.
for you, Irene, what is your views on how the institutions would use a high interest savings account?
A lot of the institutions have a requirement that you have to have a certain amount of money first to be able to put into a high interest savings account. And therefore, you can get this high interest rate, which is unfortunate because some of these amounts are pretty big that most people don't just have laying around. And if they did, I would put it into a high interest savings account.
Why do the banks say that? Why do they say that you need to have a lot of money first to put it into a high interest?
Well, because it makes it worth it to the bank to give you that high interest, as long as you have, $100,000, $200,000 to invest, or I should say save. You can go to any bank and you'll see their high interest savings account option. Might be called the premium rate savings account at the previous bank I was at. And there was always a requirement that, hey, anything up to, I don't even remember the amount, but anything up to this amount of money, you get this. And then anything over that was the premium rate. And doing that, we just made it more worth it to the bank to be able to give that high interest to that client, because the more money they have saved with the client, then they could lend that money out to the people who need mortgages, right? Or loans, right? So that's what they use this money for. I'll be honest with you, I really do not, with most of the people that I've sat down with, I don't think anybody needs a high interest savings account. Because you might as well just, at the end of the day, with inflation, if you're looking at a high interest savings account for a long-term savings strategy, which I wouldn't, you might as well just leave it in your mattress, because then at least it's not going to lose money.
Well, it's still losing money even in your mattress because the inflation's still chewing away at it.
That's true. I guess. Sure. But at the end of the day, it's like, if I wouldn't consider it. I think maybe the most times anybody would use it is if they knew that, hey, I have $200,000 I inherited from grandpa. I want to buy a house in the next few months. Mm-hmm. But I also don't just want to let it sit in my checkings account, because what if my account gets compromised? I need something that I can put it into and maybe earn something, but I also don't want it linked to my bank card. That would be a really good indication of why a high interest savings account could be used, is for that particular scenario.
There you go. You have a great scenario for it right there. Okay. Now, so you're absolutely correct. The high interest savings account is not one, just like a GIC, just like a regular bank account. It's not going to be, it rarely beats inflation, right? Yeah. So it's technically the same idea. It's losing money because inflation is chewing away at it, right? Yeah. And you were right in the sense that high interest savings accounts are so the banks love GICs, high interest savings, and your bank account. They love those three entities, and that's what's highly promoted in institutions, right? Reason why is because they're paying you a very, very insignificant return, but they're taking that money and they're lending it to borrowers for a very, very high return, right? I don't think you can borrow money at any less than 10%, but yet they're only giving you a 2% or a 1% rate of return. Okay, so that's how that's happening. So really good marketing on the institution side. High interest savings account, I come across a lot of TFSAs, tax-free savings accounts, that are literally high interest savings accounts, and it says it, guys, look at your statement. People, actually look at your statement. In your statement, if it says high interest savings account, it's not investing, right? It's literally being put in a true savings account. Okay, so it's great marketing, but low real world growth. It's really not growing. Okay, now brokers on the other hand, Irene, you just said that you rarely use this high interest savings account. You just gave a scenario where you would use it, and that's how it's used. Okay, if there's a very near to date future that you want to use it, it doesn't have to be hundreds of thousands of dollars. I've seen like $10,000 in a high interest savings account. I've seen lower, right? People coming in wanting to set up a TFSA in their institutions, and they just want to get it started, so they're starting like a $5,000 high interest savings account, right? I've seen that happen, where if you talk to a broker like Irene or myself or someone out there that you trust, get them to do if I had $5,000 sitting in a true investment portfolio, registered investment portfolio show, what would happen in 10 years as opposed to a high interest? Like, just have them do the calculation. They can do it, right? We have the tools, right? So now I want you to think of this. Okay, you were talking hundreds of thousands. So let's stick with that. Okay, so the institution says, oh, you have to have $100,000 to start this high interest savings account. That's literally like saying, I'm going to go to a car show, sit in the Lamborghini and look real cool. But that's not your Lamborghini and you're not actually driving it. Right? That's what that is. I'm going to look real cool for this moment in time. Okay, that's great. But that's literally doing nothing for you.
Mm-hmm.
Right? It's giving you maybe a bragging right that I've got all this money, but it's not doing anything. Okay, so we use it as a temporary cash flow management tool. That's really all. It's not an investment. It's just it's a temporary cash flow method.
Yep.
Okay. Like we're using it, the word park. Again, we're parking that Lamborghini. We're letting you sit in it. That's great, right? Right. So we'll park the money. Maybe it's something that's used for a near emergency fund, something that you know is going to happen soon, or short-term liquidity because we're going to be moving your investment into something else or doing something with your investment in the very short, like, I mean, very short term, right?
Yeah.
So it's being parked in those kind of things. So we're literally like, we're linking your high interest savings to a reason.
Yes. Purpose.
Right? A purpose. It's got a purpose. And that's why
not a long term.
Right. Yeah. We have long-term strategies and long-term plans, but like in any good plan, there's also going to be a short-term, right? There's short-term steps to the long-term plan. So because our lives change on like every day, our life is going to change. So we might have, the ideas of making a purchase for a house. Well, we have a plan for that. We might have, we might be going on a trip next month. Well, we have a plan for that, right? Well, I'm 25 years old and I'm going to bust my butt till I'm 35, but by then I want to have kind of my retirement laid out. We have a plan for that.
That would be awesome, guys. If you're like 25 and you're listening to that, it's 100% possible.
100% possible. So we have a plan. Like, it's not something that we're making up on. Like, there's already plans for that.
Yes.
Right. So, and depending on the advisor you use, that plan could be effective, greatly effective, or you're just getting there.
Yeah.
Right. Depending on your advisors and the tool. We did a podcast the other day with one of our seniors, in regards to, the broker, the team, the agent. The agent has a big role in that plan as well. What they can do, their limitations and possibilities. Any agent can help you. Some can help you more than others.
Yep.
Right. Depends on what you want. Right. Do you want to be driving a beater in retirement, or do you want to be driving the Ferrari in retirement? You have to make that decision. All right.
Right.
So we've covered kind of the most of the way when people go into an institution, what's presented to them.
Yeah.
Right. Other than getting, like, you're never going to get a detailed strategic plan. You're never going to get a budget. You're never going to get these kind of things laid out to you in an institution. They just don't do that. Right.
No.
But individual brokers like Irene and myself, you're going to get that kind of a service. So, I've come across people that have even talked about, I want to go into the bank because I want to get consolidation loans. I want to get, or they're thinking about consumer proposals or bankruptcy. And really all they needed was a financial plan.
Yeah.
So, but they can't breathe. Here's the thing, people, when it comes to your money, you're emotionally attached to it.
Yeah.
You are emotionally attached. And the reason why you think you need to get out of debt is because you're not thinking clearly. How many times have you guys been in a situation where you're kind of in panic mode and you make the wrong choice? Okay. That's where we come in, because we're not emotionally attached to you and or your money. So we are making the logical decision based off of actual education, licensing, right? What we're licensed to do, and experience, right? So we're literally making the proper choice for you. And in the end, if a consumer proposal or bankruptcy is the answer, we'll let you know that.
Yeah.
Right? We will let you know what your options are and what your best solution is, right?
Right.
You still will have a choice as to what route you want to get. Again, you still have a choice if you want to be in a beater or you want to be in a Ferrari, right?
Right.
But we'll help you clear up the cloud. We'll help you take away the fog and say, okay, you know what? It's time to relax, time to take a breath, and this is what's happened. Okay.
Yeah.
So as a follow-up segment, I think, Irene, we've talked about our money and we're putting it into, these investment tools, right? So what happens then? Let's do a segment on following that money. Literally walking through, where does your dollar go when you invest it at the bank versus an independent advisor? What happens to it?
We appreciate your time always when you come and watch us. We hope we're providing value. Please leave in the comments if you have any ideas as to what else we can talk about, because we'd be happy to, and I'm sure we're capable of. Have an awesome day.
Yes, everyone. And hey, listen, if there's any comments about experiences that you've had with institutions and brokers, and any experience you've had with your own personal idea of saving and investment, please put that in the comments as well. Have a great day, everybody.